The comeback of the U.S. apartment market has been one of the best economic stories in the country at a time when good news has been hard to find. And today we continue our look at revenue change by market over the past 5 years, taking a look at what's happened from right before the Great Recession up until today. So welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons, and Greg Willett is here with me to dive into these numbers. And Greg, let's get going and give us a list of the apartment markets that have performed the best over the past 5 years.
And what we're measuring here, just to remind everybody, revenue change, we're going to define that as the shift in effective rents for new leases over that 5-year time frame, plus any change in occupancy that's occurred in the market overall. Back in the first version of this series, which focused on the Sexy Six markets, we told you that the Bay Area was red hot, San Francisco #1 position across the country by a big margin, San Jose in #2. So what other places actually ended up toward the top of the list? And if you're a regular viewer of apartment market dynamics, and really shouldn't everyone be, you're not going to be surprised to see that Pittsburgh comes up on this list. And in fact, it is in the #3 spot. We've talked about this one a lot over the last few years. Revenues are up 17.7% since mid-2008. All of that growth was in pricing, as current occupancy matches the really full number that was seen prior to the recession. The headline story for Pittsburgh is the economy over the past 5 years. Healthcare and education are unusually big in this metro, and those sectors really didn't do much of any downsizing during the recession. Plus, Pittsburgh now is an energy-related market since it lies at the edge of the Marcellus shale field. And then one more note on Pittsburgh. If you want to really grow your revenues and get some strong occupancy and significant rent growth, what you do is don't build any product. And certainly that has been the case for Pittsburgh for decades, actually, so not much new supply. Moving on from Pittsburgh, another market that probably won't surprise people to see it on this top performer list is Denver. Revenue growth of 17.1% over the past 5 years in the metro places it in the #4 position nationally. Rents are up 15.4%, and occupancy has climbed 170 basis points. Performance influences here include a fast-growing economy, ideal renter demographics, and limited completions so far in the cycle. Now, that new supply story is clearly going to change. We've got a bunch of product under construction right now. That's going to cool off the performance a little bit and knock this one down several pegs on the list, but we're starting from just an incredibly high rate in Denver, so still good results moving forward.
And then number 5 on the list, we had Boston. We talked about that one in the Sexy Six video. Now let's move to the second half of the top 10 list, and we lead off with one that probably not a lot of folks would expect to see. That is Columbus, Ohio. Columbus is in the #6 position among the nation's 50 largest markets with 5-year revenue growth of 15.7%. Rents are up 13.9%, and occupancy has improved 180 basis points. And the hit that Columbus apartment market saw during the recession was really comparatively mild, and that was helped by a few factors. Number one, the economy here is dominated by some relatively stable sectors, higher education and government, 2 areas that just weren't hit very hard at all during the downturn and actually continued to grow to some degree. Plus, Columbus was a place that had virtually nothing in the construction pipeline when the recession hit. So when demand briefly turned negative, it didn't have a outsized effect on occupancy just because there wasn't much in lease-up. And one more observation on Columbus. Columbus deserves a special shout out because of the operator behavior in this market. Operator sentiment plays a huge role in pricing decisions in this industry, and in much of the Midwest, there seems to be some hesitancy to raise rents even when more aggressive pricing strategies seem appropriate. But Columbus owners and managers have done a really good job of consistently taking advantage of the opportunities that have been available given the attractiveness of this market of late. And next up on the list, we've got the first of the Texas markets, and it's one that no one's going to be surprised to see, Austin, the state capital. Revenues jumped 13.4% during the past 5 years. Effective rents grew 11.2%, and occupancy improved by 120 basis points. So like Columbus, you got the state capital and a major state university. In Austin, the recession barely registered at all. Of course, that was the case in most Texas cities, but it was especially true in Austin. And you add to that Austin's terrific renter demographics, and that makes Austin one of the nation's best demand centers. And it's important to note, though, from here that Austin is probably going to be working its way down the list of top performers. While apartment demand should continue to be impressive given those great demographics, it's unlikely that absorption can keep pace with the absolutely huge supply volume that's on the way. So occupancy is certainly likely to backtrack from its currently stronger than normal position, and rent growth, particularly the top end of the market, is certainly likely to cool. Now, next on the list, in the number 8 position, we go back to the Pacific Northwest, to Portland. Revenues there are up 12.8%, reflecting rent growth of 11.8% and occupancy up 100 basis points. Portland shares some characteristics with quite a few other markets on the top list here. Overall job growth has been pretty substantial at a time when product deliveries have been pretty limited. However, this is one that differs in some ways as well, in some very important ways. Portland does have a good track record of late of job expansion. However, a lot of these jobs tend to be lower paying jobs in some of the less attractive job sectors, and compared to a lot of other markets on this list, for that reason, Portland looks a little vulnerable going forward, just because we appear to be possibly nearing that rent ceiling on affordability and what residents can afford to pay. We think occupancy will remain extremely tight, but rent growth at the levels we've seen of late just might not be sustainable.
And Jay, I'll wrap up this list for the top 10 performers. And actually, we have 2 spots that tie for the 9th position nationally. One is Oakland. Again, we talked about that one back when we did the Sexy 6 video, since we put it into that broader Bay Area category. The other one is Houston. So for these metros, both of them have revenues up 12.5% over the past year. Looking at Oakland, the split is 11.7% growth on the rent side and 80 basis points in improvement on occupancy. Houston, we have 9.6% rent growth and the biggest occupancy climb among any of the markets that are in this top performer list. Occupancy up an impressive 290 basis points over the past 5 years. Focusing in on Houston a little bit more, it's really hard to overstate how fantastic this metro's overall economic performances have been of late. The metro has been just a true job production machine, and in turn, demand for apartments over the past 5 years has totaled 64,000 units. That's a number that simply blows away the results seen in any other metro across the country, and that demand number is the equivalent of absorbing in just 5 years essentially every existing unit that exists in a place like Louisville or Birmingham or Tucson. Part of the economic story in Houston, obviously, is the energy sector, but you also have some other economic pillars now. The trade activity around the port makes a huge contribution to this metro, as does the medical field. Is just a huge medical center at this point. And something else to point out about Houston, international investors love this market now, and certainly we've got a lot of capital flowing in there. Houston's run in this cycle actually does look like it has some legs to it. What could screw it up would be you build too much product, but right now what we see is overall construction is pretty manageable. You do have to take a look down by neighborhood and submarket, though. The urban core may be a little bit overheated in terms of construction activity there.
Baltimore registers in the same general category as many that we've just talked about, just missing the top 10 list by 0.1%. And then there's a cluster of markets with revenue growth right around 11%, and that includes Nashville, Chicago, Washington, D.C. And that wraps us up for this edition of Apartment Market Dynamics. And join us for the 3rd edition of this series, and we'll look at the worst performers among our apartment markets over the past 5 years. So until then, for Greg Willett, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.